Thank you. I guess we should start. Thank you for bearing with us. So, my name is Abhimanyu Arora. Uh, I'm the director at HBITS. First of all, thank you everyone taking out time this Thursday afternoon. Today, we'll be covering a very special topic, which we covered approximately 2 months back, which is basically again on commercial real estate investing simplified. In this webinar, we'll be talking about how we acquire property. A couple of slides in the start will be only for the few people who have just joined in fresh and new and want to understand what SM Reach is all about. In the meantime, whenever you feel to just put in your questions, you can just type in your question and we will answer them at the end. And we will be as well sharing a couple of information in this webinar. Number one would be, of course, from the acquisition team, how the markets are currently behaving. And second, we recently did a second exit of one of our properties in Mumbai, and we've created a case study, what we looked at and how we did this particular exit. So to start off, let me just introduce the leadership team at HBITS. Mr. Shiv Parekh, founder and CEO. He's a Harvard graduate, Stanford alumni, uh, City and Stanford Management Company. That's his experience where he comes from. He's as well a second time entrepreneur. So he as well started a co-working space before HBITS, and this is the second time he came and it's become a regulated product under SEBI platform. He's Forbes Asia 30 under 30 2022 and Business World Disrupt 30 under 30 2022. As we will talk about Mr. Sameer Bhandari, who is our co-founder and CFO. He's worked for approximately 35 years in different companies, to name it as JP Morgan, UBS, sales in, he's worked with Nomura, he's worked in, different companies. He worked with Lehman Brothers, then the Nomura Securities took it over. He's a chartered accountant and MBA from IIM Ahmedabad. Just to talk about a bit about myself, before that, I'll just talk about Sarthak. We have Sarthak over here, who is joining us, who is actually the head of Department of Acquisitions. He takes care of the entire acquisitions and the exit of the properties. So Sarthak joined us approximately around 2 years back. With coming to his experience, he's an MBA from ISB, Masters in Architecture from Georgia Institute of Technology, and Bachelor in Science of again Georgia Institute of Technology. He worked around 8 years in the US with KPMG, where he was looking at real estate and infrastructure practice. And of course, another company which is he was a head of real estate and asset management, Travel Center of America, which is basically a Fortune 500 company. Now, of course, under the BP portfolio. About myself, my name is Abhimanyu Arora. So, hi, Sarthak. Thank you, first of all, for joining us. We want to do it quite often with you and get to understand more market understanding. But yeah, we wanted to get to it because people are pretty anxious why we are taking a bit extra time to acquire our property. So, we'll just talk about that a little later.
Oh,
Well, just to introduce myself, my name is Abhimanyu Arora. Overall 25 years experience, worked with banks like HDFC, HSBC, DBS Singapore Kotak, purely into wealth management, treasury, and forex. And I'm Calcutta alumni. So coming back to a bit of small topic in regards to what is SM REITs. So we talked about earlier, this product was called fraction ownership. And just to let you know, on 1st of April 2025, SEBI has regulated this product. Erstwhile fraction is now called SM REITs, which is small and medium, of course, REITs. Small and medium real estate investment trust, SEBI approved investment vehicle focused on premium leased commercial assets. So clearly, just to mention, we only deal with premium pre-leased commercial properties. It could be an office, it could be a pre-leased college, it could be a pre-leased hospital, and other avenues which yield you or get you or earn you an income from day one. It's professionally managed, it's asset specific investment, no related party transactions. Just to give you a bit comparison, how the difference between different asset classes, which is FDs, bonds, and debt mutual funds. We compared a little bit in this slide on SM REITs, but we'll be elaborating a bit more on this as well as the global market On our next webinar, we'll show you the dates with you soon. Just to talk about SM REITs, where the yields we are talking about, it's about 8% tax-free income paid out quarterly. And with the capital appreciation coming to picture, it will be approximately 14 to 17% IRR. The liquidity is moderate. The rentals is tax-free paid out quarterly. SEBI-regulated regulation. Market risk is low because it is rental backed. The contract is already signed in advance. The investment value is 10 lakhs or multiples of 10 lakhs. Transparency, of course, high because it's we do the due diligence in advance and audits as per the SEBI compliance on a regular basis. In FDs, we see 6 to 7%, but the income is taxable. The liquidity is high because you can always go and liquidate it. Maybe there is a very small portion where the penalty is there, but the liquidity is high. The taxation is fully taxable, regulated by RBI. Risk is low. Of course, multiples of 1,000 or any amount above 500,000 is available to start that particular investment. And of course, the transparency is needed. When we talk about bonds, the yields are approximately between 6 to 8%. To talk about liquidity is moderate, taxation based on the type of the bond. Regulation, if I talk about, few of them are RBI and few of them SEBI, depending on the market and which vertical which we are looking forward to pick or compare. The market risk is moderate, rate sensitive, and investment amount above the value of 10,000. And of course, depends on the issuer. That's how you can always look at the transparency. Well, we are and always in love with the debt mutual funds, but if you look at the comparison with FDs and bond debt mutual funds, it's almost equally the same. Over there, the debt mutual funds give you around 6 to 9% subject to NAV risk. The risk is a bit high because it can be a little volatile with the current scenarios where the rate cuts are going down, but it all depends on the benefit. It's going up or down. Taxation, indexation benefit if LTCG, regulation, SEBI regulated. Long-term capital gains in debt is only 12.5%. Regulation, semi-regulated, market risk moderate to high, investment amount is 500 plus, transparency is NAV based. Now I like to call in, Sarthak to talk about a bit about India's commercial office space snapshot for the Q3, particularly for 2025. And of course, Sarthak will take us, and I'll just run through the slides wherein we'll talk about market trends and other things. Over to you, Sarthak, and thank you for being participating, giving us this time this afternoon so that our customers were actually asking if we could get some input how we acquire and what are the current trends in the commercial market space.
No, absolutely. Thanks for having me. Glad to be here. So just jumping into the commercial office market right now, we found that last year was a record year in terms of total leasing, and right now, as of Q3, we are already looking to surpass that. I think as of the moment, we are about looking at 20% or so higher than the year ended last year. So that's indicating very healthy demand. For commercial office space right now. And a lot of this is being driven by fresh leasing. So about 80 to 84% is fresh leases entirely, which is attributed much to the fact that many companies are looking to expand, growing. We're seeing a lot of further GCC demand. Earlier there was a question a few months ago with tariffs, what's going to happen to GCC demand? In fact, we've seen that actually increase further now. GCCs are accounting for 32% of the total leasing volume that we're seeing. And so this is leading to a good increase in our overall leasing volumes, and accordingly vacancy is also falling. 15.7 extremely low, and if we look at different cities, some of them are in the single digits as well. So extremely healthy and a good time for the real estate market. The way things are going with new stock coming in, we are looking to become a 1 billion square foot market in the next 2 years. So that's a big mark that we'll hit. And given the amount of absorption that's actually happening, even with increased supply, and most of the supply that we're seeing is catered to grade A, we still expect that the vacancy rate will hover around this number. And the supply that's coming in as well is focused on some of the core markets like ORR in Bangalore, Gurgaon, BKC, and Madhapur in Hyderabad. So we expect to see some new additions in some of the most sought after micro markets. And that in fact has such robust demand that despite additional supply, vacancy is expected to stay around where it is at the moment. So on a sort of year-on-year basis, Hyderabad has recorded the highest rental increases, and it's actually very interesting. Was in Hyderabad a little while ago, and how the Madhapur high-tech city belt is squeezing to such low vacancy levels that people are moving to other micro markets, financial district, Gachibowli, etc., because they're unable to uh, find any supply in the core markets, and there's not much land there as well. One or two new projects have just been announced by uh, Prestige and so forth. And then Kolkata also had good year-on-year rental increases. Bangalore has continued its momentum and at 8%, with it is one of the biggest. It is the biggest office market in India and continues to have year-on-year rental increases of this nature. So very healthy market. And as I mentioned, BKC, Gachibowli, etc. These markets are driving a lot of demand. What we're also seeing, in terms of overall leasing, Delhi has been a big share. We've seen new supply also in Delhi, but also huge amount of new leasing, close to 30% in terms of total quarterly leasing, and also one of the best year-on-year performers too, which not on the slide, but just generally mentioning this as well. And Mumbai has had a notable increase in terms of pre-leasing. So we are aware that Mumbai has always been generally a supply constrained market. So the new supply that's coming in also is getting pre-committed. So if we talk about new projects in BKC, Andheri, etc., that pre-leasing trend is really taking in. So that also speaks to the fact that we won't expect vacancy to move that much, given new supply is already being leased before it comes to market. So very strong momentum overall. Right. So as I mentioned, Delhi with some of the highest leasing share, 56% year-on-year growth. Uh, Bangalore still the largest market, and Mumbai with dominant share of pre-leasing. We're also seeing good trend in Chennai, which I hadn't mentioned before. So yeah, GCC trends, as I mentioned, 32% of total, best ever 9-month performance, and we still only have barely 20% of global Fortune 500s that have GCCs in India. So we expect this trend to continue to grow. When we interact with our peers at the IPCs like JLL, CBREs, and others, who frequently go and in fact interact with their clients in the US and other such places which are driving GCC demand. They're seeing that right now with AI and things like that, there is actually more of an opportunity where they see GCC growth to continue. So at the moment, in terms of where we see our sort of next 5-year pipeline, I think GCC demand from that 32% will continue to grow further, leading to further demand for high quality space. So vacancies and rent growth, vacancies being low and rent growth being high, certainly is going to be a trend for the time being. So, jumping in a little bit about how do we go through our acquisition process, and Abhimanyu had mentioned eagerly waiting for the first asset, and why sometimes it takes a while to mature the deal. I'll sort of touch on it a little bit because of the criteria we actually look at, right? So typically when we're identifying and sourcing assets, we have an extremely broad funnel. I mean, we would be getting close to two opportunities a day, and out of this, as we sort of filter down in the evaluation process, and I'll probably talk a little bit more about some of this in detail through the next slides, but the criteria is so detailed that almost only 1 in 10 properties even moves to the phase of the deep dive analysis, right? So we have a very rigorous uh, checklist that ensures how we maintain minimal uh, or how we maintain minimal risk to the investment, and that's the goal of our entire sort of product, right? So 1 in 10 properties might move to that phase, and then you get to negotiation, and there, of course, the yield between where a seller expects and where we would like to place something, we have to bridge that. And today, we'll also again talk about this a little bit, but we're seeing a lot of reduction in yields coming down, given there's a lot of institutional activity, there's a lot of capital appreciation and very low vacancy rates as well, right? So now, and with sort of interest rate cuts as well, so coming below 8% is becoming we're seeing more deals in those marks as well. So jumping in, how do we identify and source assets? Sourcing through our network of IPCs, brokers, developers. We are doing a lot of direct relationships with developers so that we can ensure we identify assets much before they actually come to market, and that's sort of how the pipeline will be long term. So we're not looking for just the right deal today, but also the right deal 2 years from now, 3 years from now, that may be in under construction phase today. And our relationships with developers from past transactions we've already done, many cases repeat transactions as well. And we really do focus on top performing micro markets, right? I mentioned a few of these earlier on, but there, even if you're slightly lower than 8% and where you ideally want the yield to be, the opportunity of upside with rent growth is so high that IRRs are usually going to outperform in those micro markets because vacancy rates are so low. So it's a very strong sort of strong case to make for a micro market and paying a little bit of a lower yield for a higher IRR in the long run. So, in terms of what we look at beyond the asset, a tenant profile is extremely important to us, making sure they're corporate MNC tenants. This makes sure that you don't have any credit risk, right? And that's a very important piece of a real estate business. We make sure we benchmark that even if the yield is good, but if the capital value is not in sync with the market, we want to make sure that capital value is also in sync with the market and not so yield and capital value really have to match. And micro markets I already touched on, but infrastructure connectivity is becoming a big reason these days why someone pays a higher rent. So looking for assets that have that access to metros are expanding everywhere. We're seeing more infrastructure from roads as well and highways. So keeping that in mind is also really important. And today you're seeing a good trend for green certified buildings as well. So grade A buildings, but that have some kind of lead and well certification. It actually helps a lot of tenants meet their ESG criteria, and so they do pay a higher premium for those assets as well. So these are sort of the things that are becoming prevalent in the asset acquisition criteria. And like I mentioned, from negotiation perspective, always need to be the yield and capital value have to match. Make sure that we're competitive against fair market value, and focusing with long lease tenures, good rent escalation, and so forth. So definitely you want to minimize any risk for investors. That's the product. That's the goal, and we make sure we look at every criteria to do that. And from a due diligence perspective, we have a thorough sort of checklist from legal due diligence to make sure title is clean, making sure lease agreements are thoroughly vetted, financial due diligence, and then technical due diligence of the asset itself, right? So that could be the building quality, plumbing, fire adherences to code, compliance with RERA, etc. That's all very thoroughly done. And then an independent third party does evaluation to make sure that what we're paying is also in line with the market. I'll pause here and see if Abhimanyu, you have anything to add. Maybe you can talk a little bit on the regulatory structuring as well.
So before that, very interestingly, while you were just talking about rental trends, particularly about Hyderabad.
Yeah.
So we've been talking about really good amount of supply over there, and we see that there's an 18.7% rental growth. Uh, Pretty surprised with the demand and supply. Is it the part of the economics which we learned? So, so that's what I was just trying to figure out. Maybe
It,
because
yeah,
it's a good demand location for grade A supply,
absolutely.
which might be coming up. Maybe that's kind of catching up with the momentum. That's what my take. What do you think about that?
Yeah, so there the demand in Hyderabad is so high, and Hyderabad, if we think about total stock of the supply in Hyderabad, right, it wasn't as high in the last 3 years, as you would say, Mumbai, which is already established. Gurgaon has been established for a while, so that NCR belt also has a lot of high stock. And Bangalore, being the biggest office market, Bangalore saw that GCC and tech trend, 10, 15 years back. Hyderabad has started seeing it maybe a little bit lesser of that time frame. And so, and now there's actually continuous demand both for Bangalore and Hyderabad. So Hyderabad didn't have as
Perfect.
much stock of that supply before. And so the sought after micro markets there of high tech city are completely constrained. I mean, there's almost no vacancy, and so that spillover then moves to uh, the next sort of micro market as well, right? And Hyderabad, if you see in most cases, has huge buildings, like buildings of million, 2 million square feet. So that plays a little bit into the sort of vacancy factor over there. But sought after micro markets are still filling up with year on year rents going really high because the demand is actually just continuous in Hyderabad at the moment compared to the actual total stock available.
Noted. Very interesting, to be very honest. And I have one more question which I'll ask later.
Sure.
So just to cover where Sarthak left, and he mentioned you talk about regulatory structuring, where the investors are protected first. So asset holding is under SP, which is basically a trust. Investors' rights clearly defined in the legal agreements. Like when we talk about our first, when we sign the term sheet, let's say in a small time from now, and then we sign the DRHP, fill in the DRHP, in the prospectus. All the details will be mentioned over there when you are going to invest, right from the cash flows, right from the tenant, the property, how the process will be laid down, what are going to be the guidelines, the different talk about transparency on fees distribution and exit mechanism. Audits, of course, since it's a semi compliance, there'll be regular audits as per the compliance made. A bit about what are the risks and how HBITS mitigates them. So we only and only deal with grade A tenants with a good rental track record. To talk about, we have a tenant which is Microsoft. We have Foundever, which was earlier Citel. We have MAN. We have ICICI. We have IIFL. We have Smith. We have Gupshup. So we've been only talking about dealing in the grade A tenants. Vacancy risk, of course, we kind of covering that by getting only those tenants which wherein the rental contracts are in 3 to 9 years lock-in leases. And if I'm correct me if I'm wrong, Sarthak, any property which we are looking at this moment are having a good lock-in periods in advance.
Yeah, so there's a mix of long tenure and lock-in. The historic tenancy of that tenant over there, like how long they've been there. In many cases,
Mhm.
it might be their some kind of R&D center, things like that. So
Right,
even if it's out of lock-in, there is no risk that they would vacate. And also, we're setting up that if there's dependency on a certain tenant, then can we have some kind of binding term sheet? Those sort of things are being made sure we do before we close a transaction to
makes
make
sense.
to mitigate any potential risk.
Makes sense. So in terms to liquidity, because it's going to be listed when how you subscribe for an IPO, which we look forward to be doing in the month of January, uh, and Jan mid. We look forward that it's listed to your DMAT. You should have a DMAT account in place. And moment the allotment of shares happens to your end, which is as per the NAV, one unit will be equal to 10 lakh. It will be either in the NSE or the BSE. So whenever you want to exit, you're most welcome to do that from the exchange. However, people who want to, as per the diversification of portfolio, it will be suggested to park the money between 3 to 5 years in this asset class because the asset underlying is property. You need to give time for the property to appreciate. On tax on rentals, it's tax free, targeting 8% tax free returns paid out quarterly. However, we as well see that another 12 to 15 months from now, after the first IPO, it will come back to the same zone of monthly payout. Transparency, of course, as I mentioned, regular reporting, SEBI disclosures, and misuse of funds. It cannot be possible because third party audits, SEBI regulation, SPV structure. Well, as I already mentioned, and before Sarthak gets onto this particular topic, like to mention that this is our second exit. We've already done one exit in 2021, wherein the targeted IRR was 15.54 and we delivered 17.54. I guess it was close to 18% that time. And it was a great exit in a matter of just 18 months. This exit, which we are talking about, is an asset which is a premium property based out of Andheri East uh, by a premium builder, Raheja, which we exited. This we did in a matter of, I guess, 3 years. Well, to take it forward, why don't you, Sarthak, just share a particular something about the property? Of course, I know it very well, but good to hear from you.
Yeah, sure. So I'll talk about how the acquisition criteria sort of plays into this case study, right? So it was in a very strong micro market of Mumbai, which is from when we acquired, which would have been around 2021, 21 and 22, right? To at that time itself, we were seeing huge demand and very little supply at that time. So that was one of the reasons why we identified this. Then we had a lease agreement with a managed workspace provider, but backed with another uh, MNC, right? So it was a back-to-back managed office agreement. And while our lease tenure was 5 years as a leave and license agreement, there was already a term sheet in place for 15 years, right? So we had that long-term credibility in place. And given the conviction of our investment at that time and that micro market, the rent of 117 seemed just about at market at that time. But by the time we exited, the market had moved closer to 170. And this asset was based on the escalations closer to about 150, 160. So given how we sort of given that market's exponential growth, we when the next term kicked in, there was a adjustment in the rental, and we were able to then sell it right at the start of the next renewal term, giving maximal IRR to our investors. And the actual achieved IRR on an unlevered basis, 14.74%. And we got a capital appreciation of almost 20% in 3 years.
Great. So I could say that the earlier one where we targeted 15.54 delivered 17.54. In this one, the targeted IRR in the brochures when we sold was 13.10 and we delivered 14.74. So of course, it makes a lot of sense to share this particular information to our future investors and our current investors who look forward to be a part of this investment opportunity, which will be coming very soon. Because the performance track record shows very clearly that it's not just the ROI, it's the acquisition part, and as well as the entry price point, which make the major role to get such successful exits. Well, coming to this particular slide, we asked Sarthak particularly to talk about market trends which are currently happening, and we just name certain buyers and sellers and timelines where the transaction happened. And of course, I have a question after this. So, Sarthak, over to you, please.
Yeah, so this is like an example of what I wanted to mention, though. But the main story that we're seeing is capital values are really strengthening of late, right? Given the rent increase, vacancy falling in prime markets, I mean, there's just a lot of demand and less people that are also selling at the same time because rental rates have been going up, right? So, given that, we're seeing a sort of compression in cap rates. And there's also a big amount of institutional sort of ownership that's coming in nowadays. You'll see that REIT markets have really picked up. Knowledge Realty Trust came recently. There's always in the news. There's be it Brookfield is very active. Others are also being active in the market today. REITs are doing acquisitions. Mindspace just did one in Hyderabad. So you're seeing more institutional also participation, and that combined with the overall market as it is in terms of demand supply, has seen a compression in cap rates. So where we were, say, in the 8 to 9% on a broader sense, and I'm referring to a city like Mumbai, right, where 8 to 9%. Now we're seeing that yield compression in cities like Mumbai to be between 7 and 8, possibly. Like GIC had an acquisition from Brookfield at Equinox, 7% or so. right? So that's one example. You're still seeing broader market 8 to 9 possibly achievable in in Delhi NCR, Hyderabad, and so forth. But broadly, good amount of yield compression that we are seeing coming in, and that's actually a sign of healthy. It's a healthy for the overall investor sentiment, right? Because say we do an acquisition today at 8%, uh, and the track continues the way it's going, when we go to sell in 5 to 7 years, you'll be able to get an exit closer to 7%. That's an inherent increment in your IRR that you'll be able to achieve. So this is actually a very positive sign for what we are doing, and hence I wanted to just mention that the market is very positive for these kind of investments.
Thank you, Rajiv, totally. Uh, well, before we get into the Q&A session, just like to as well mention, it could be a possibility on this rate trends. And so, as we know that the FD, we've been seeing rate cuts in the Fed rates, which of course the RBI is further cutting the rates. That automatically means that the prime lending rate goes down, right? Which automatically, as well, says that people who are looking out for properties which have loan against rental, discounting, the rates are lower. So they tend to buy more properties in that particular cycle. Automatically means the people who were looking forward to sell, the rentals interest income has gone down, so they are not looking forward to sell. Interestingly, the demand is now high and supply is less, and probably that could be one reason where the rental rates are going down. Do you think, Sarthak, that could be one way to look at
Rental rates going up, right? So
the
that's
rental
that's
percentage because of the property price going up?
the yield, you mean?
Yes.
Yeah, yeah, right. So, yeah, the yields are going down for a variety of reasons. I mean, rental rates going up, of course, is one. More buyers in the market, right? That's also there, and also conviction in the broader market, right? So, today India has become a high conviction market. You're seeing a lot of global institutional capital come in, especially from Asia as well, and from global funds. India has become a priority market, right? So I think everyone has a conviction. So you're starting to uh, pay a little bit a premium, and that's why yields are coming down as well.
Noted. So we'll just jump on to the questions now. We have a few questions already lined up for our investors. The first one to us from Mr. Anil, how come it is tax free 8%? Well, I'll just explain you that. Well, what we're doing over here is so our taxation partners is ENY, Ernst Young, and we'll be having a taxation note available for you to see. Give an example. Let's say you invest 100 rupees, and let's say the coupon rate is 8%. Okay, we are not giving you that as an interest income or a dividend or any other format. We're giving you that as a return of capital, not return on capital, return of capital. Automatically means the 100 rupees which you invested has become 92 in the first year. So that is how return of capital is happening. Uh, Anonymous attendee, for investment grade bonds, the returns are 11 to 13%. Well, yes, it depends on the B grade, A grade, and the cycles over there. If I have to compare over there in this particular scenario, SM REITs are basically looking at between 14 to 17% IRR. Mr. Mohammed Tanveer Alam happens to ask, how are dividends, interest, and capital gains taxed? Well, dividends, of course, there is a dividend distribution taxed over there. Interest is taxed as per the full slab of the customers, as per their taxable slab. And capital gains is basically long-term capital gain tax, which is basically 12.5%. Mr. Mohammed Tanveer as well asked, is REIT better than buying a physical commercial shop? Well, it as well depends on your capital value, which you have. Today, if I look at uh, a scenario where if you're comparing with REITs or SM REITs, that's one part to look at. But if you're saying is REIT better than buying physical, I'm assuming that you're talking about SM REITs right now. Uh, not every person or an investor has a potential value or a resource to park in 3 crores or a 4 crores or a 10 crores. Because see, if let's say your value, you have a budget of 30 crores, then you can think of getting a tenant which is a grade A tenant. Idea of getting a grade A tenant will mitigate your risk. So in that particular per se, to have a good A grade tenant and the entry price point to be good because you're buying a block of the value of that particular property. It's always suggested that you can deal into REITs, SM REITs, which we're talking about, than a physical commercial shop. But with buying a physical commercial shop is, of course, traditionally what we have been doing as Indians. We love to buy properties. At this moment, I'll suggest that the REITs is the way to go, where we are taking care of professionally managed assets, and the income is, we have already shown that. How safe is office real estate during economic slowdown? Well, to talk about one of the things which we saw in between COVID. So our legal transactions, or I should say the contractuals are very, it's like what they're like watertight. Our lawyers, legal partners are Cam, Sam, Trilegal, and all these people where we look at the contracts just before entering into the proper transaction. So forget about negotiation during the COVID times. We never had a delay in the uh, a single day delay in the rentals as well. So that's kind of a thing how we could look at. It's perfectly safe because you already rented out to a grade A tenant. Mr. Muthiar Ahmad happens to ask, can SM REIT be monthly paid instead of quarterly? Yes, it can be paid monthly then quarterly, but as of now, it's as per the SEBI guideline paying quarterly. We see that from around 15 to 18 months from now, it will be moved on to monthly mode for sure. Why SM REITs launched currently are not offering in performing in market? Well, they are very well performing in the market. If you're looking at the last, so we have the only two companies over here right now. The other one is PropShare, and I'll be very much vocal about it. The last asset which they did was around 450 crores, and they were able to get a 2,500 odd crores rupees, you know, a 5x kind of a value overall. So they are very much performing. And if you look at the NAV value, there's one understanding which it's my duty to share with everyone that let's say the value is 10 lakh. It might go down up, but it's like kind of a daily demand and supply. But one should know that as an organization of SM REITs, we have to submit the valuation report to SEBI every year. That means the NAV will change every year per se the valuation of the property. So one should look forward to be invested into the property for 3 to 5 years. And if the NAV changes are happening, particularly potentially, then you should look at a 1 year kind of period post that. Anonymous attendee. As we can explain, if we can explain taxation for investment of 30 lakhs, rental yields 8%, 5 years down the line property, appreciating 6% per annum. Is this a realistic case to investors? Yes, it is a very much realistic case to the investors. I can rather give you an example. Karthik, of course, moment I get something related to property, I'll ask you. So you can bear with me on that particular front. So just to let you know, giving an example, 100 rupees parked it, rental yield 8%, 5 years down the line property, appreciation per annum. It is and not a realistic, it is the ideal case, and we are looking forward that it could be appreciating anything between 5 to 7% annually, looking at the current market trends. Because if you look at the asset classes and the peer grade index, this is the asset class where people are looking forward to invest, and specifically commercial real estate. Sarthak, yes.
I'll add here the rental yield entry may be 8%, but average over 5 years will be much higher. Typically, you have year-on-year escalations, so that average yield might be closer to 9 something, right? So it's not a fixed 8% until you exit.
Correct. Uh, Question from Priyanka Goel. How does the ROI work in case of recession? As I've already answered earlier, when it comes to any economic slowdown, so of course this is equal to the same particular recession. So I don't think so there will be any changes because it is a rental is already contracted. It is already done in place, and you'll be able to see the cash flows in the prospectus on day one before you invest for the next 5 to 7 years. Question from Rajiv Chawla. How does it qualify the rent to be tax free? Well, of course, we've talked about it, and if you're in touch with any of the our investment managers, please feel free to reach us to them. We will be love to share the E&Y tax note to you by maximum, I guess, 10th of December with you, and we can get it done. Not to worry on that front, sir. A question from Priyanka Goel. One more thing, when exactly HBIT decide to exit from an investment? So, of course, there are many analyses one looks at. I'll ask Sarthak first of all too, so that there's a good question coming for
Yeah,
acquisition part. Sarthak, why don't you just pump in?
sure.
When is the exactly
Yeah.
the time? Yeah,
Yeah, I'll jump in. Of course, in many cases, we have year-on-year rental increases. But during the course of the holding period, say we think we'll hold between 4 to 7 years, right? Then sometimes what happens is a lease is expiring and has to be renewed, which gives you an opportunity to get a mark-to-market adjustment, where the rental will increase more than the 5% what was happening contractually. So it may go from 100 to 110 or 115 instead of 105. So then that's when it's an opportune time to exit, because you held the asset for say 4 years or so, you've gotten a good rental income, and now you're getting a big bump in the value because the rent has adjusted to the current market rate. So those are the things we look at when exiting an asset. When is the best IRR opportunity we can make for our investors? Typically, though that's sort of the premise. If we think that the market or the rate that we are getting in the market today is not in line with what we should get, then we'll wait a little bit more till we can get that rent adjusted and get the right capital value. So that's sort of how we think about the exit. It's never hurried or it's never fixed that it should be exactly when 4 years hits. It's about getting you the maximal return. So we give a range that we hold the asset for. And I can take the next one or two questions also.
so
So next one is, whom are you partnering with regarding legal and financial due diligence? So from a legal due diligence perspective, we work with your grade A firms, Shardul Amarchand Mangaldas, Cyril Amarchand Mangaldas, Trilegal, DSK, etc. And for financial due diligence, we work with Deloitte, EY, and such. And for tax also, we work with EY. Those are the kind of firms we work with. And then one more is, when the lock-in was nearly 5 years, why Andheri property was exited in 3 years. So we actually exited in 3 years of us holding it, but the asset was already in lock-in from before we bought it. So we exited actually exactly when the lock-in was ending. So it was to get that price with no lock-in for the next investor. That was how we managed to exit the asset, and that's why we think it was right time to do it, and we got a good value for it as well.
right. The next question is from PR. How rental income is factory? It's the same question. We've already answered that. But overall, for people who just join in, or maybe, just to give you an example, a little bit in detail. Uh, so this one, again, I'm talking about 100 rupees parking today. Let's say 8 rupees is a coupon rate. Okay. I go back and give back to, let's say, a person investor 8 rupees. That is out of 8% is the coupon rate, which is return of capital, right? So that means year one, your 100 rupees will become 92, right? Same, I'll do it second year, third year, fourth year, fifth year. So 5 years, I gave you 8 rupees each year. That means 100 rupees property became 60 for you. Well, after 5 years, your property, which was at 100 rupees base, sold at 150. So 150 minus 60, which is currently 90 rupees. On 90 rupees, you'll be charged LTCG of 12.5%. In a very comparison, earlier, if we would have given you, let's say, an interest income, right? Where income tax, it was taxed to you as income tax, let's say 30%. So 8 rupees, and then your income was, let's say, around 5%, 5 rupees. So if I give you the same example with the interest income part, and the second part will be SM REITs. In part one, where the interest income was given, 5 years taking the same parameters, property bought at 100, sold at 150, 8 rupees being the coupon rate. If I look at the end analysis, after 5 years, my net income in the part A of the interest income would be around 173 rupees post tax. Whereas if I use this particular method of return of capital, and I pay only on the LTCG, that is 12.5% different, the value is coming approximately 182 rupees. So there is a good 8 to 8.25% difference on just 100 rupees. So it is a much better taxable, or giving you better yields in the hands of the customer. Well, next question. Why should one go with SM REITs when the projected returns is just 8%, whereas REITs
I
is
can
offering 40? Yeah, please.
Yeah, let me jump in here. So,
Please.
actually, when a REIT says it's offering 11 to 13%, that usually means IRR. It does not mean yield. So when we are saying 8%, we are saying that's your entry yield, what you get on a quarterly basis. That will keep increasing every year. Eight will increase to 8.5 to 9, and so forth. And when we sell the property, your yields plus the value gain of the property capital appreciation will give you a 14 to 17% return. Now, in a REIT, they're giving you a yield of about 6% on average from amongst the 5 7 REITs that there are. And they're not really in the business of holding an asset to sell. They are basically combining a bunch of assets. Our goal is to hold it and sell to get capital appreciation. Theirs is to hold the assets and bring them together. So your return in a REIT is basically the stock price appreciation that may happen over time, not necessarily a purely capital appreciation, which is what we are doing in SM REIT. So in a balanced portfolio, of course, one should have a look at both. But SM REIT will give you a higher yield and uh, in most likely scenario, a higher return as well.
Great. The next question is from PR. If it is rental return of principal, then the amount which the investor will get back will get reduced too. Yeah, so already answered that. Just I'm happy that I gave a detailed explanation on this. Well, question for you, Sarthak. So, question from Rajesh Kadam is how maintenance of property is managed by REITs?
Absolutely. So there are two, three different ways of doing this. In some cases, a developer that is selling the property may continue to manage as they're on the ground and it may be part of a broader campus. So in that case, the common area and maintenance charges will be collected from the tenant and passed on to the developer. In some cases, it could be a standalone building where we employ people uh, on the site that may have already been there and continue. And then we self-manage that property, but there will always be local people employed within the SPV that's holding the asset. And in the third case, we may hire like a JLL or a CBRE or something that does facility management services, and that comes out of the total rental and maintenance that we collect from the tenant. So it really depends on an asset by asset basis. But in most cases, we'll opt to have professionals manage that can do the job to maintain the asset at the highest quality so that we can keep it up to the standards of grade A plus that we're looking at.
Great. So there's a question from Mr. Raghavendra, liquidity related. Even though this gets listed on NSE or BSE, since the trade volume is low, is liquidity achievable? Well, just to mention, Mr. Raghavendra, currently, if I look at the SM REIT scenario, people invest in this particular asset class to be there for 3 to 5 years. Okay. Uh, at this moment, I don't see there is any liquidity problem on a peer group, which is like a per platform where it is already listed. I see approximately 2 to 3 crores of liquidity daily available. Indeed, I'll share a particular instance where there was a availability of just approximately 3 units of 30 lakhs, and I personally know at least 15 clients who tried it, but they were able to get just one. So liquidity is not a problem. To be very honest, supply is demand is not a problem. To be very honest, in this particular line. Question from Anil Gupta. Based on your explanation of tax-free returns of capital, it will be mean we eventually have more capital gain at the time of final redemption. Hence, one needs to pay more tax unless there is no return. Is that correct on it? Well, you have interpreted it right, but as I shared the analysis of between 100 rupees taking into consideration scenario one versus scenario two. In scenario one, you're paying 30% tax as per your slab on from day one. In scenario two, you're paying LTCG of only 12.5%. So this is more efficient in comparison to the scenario one. Subramaniam K, how's the returns on exit traded? I mean, capital appreciation, and also what's the targeted year of exit? Question for you, Sarthak.
Uh, so basically, this is just taxed. on the it's same part of the tax discussion that we're having, right? So if you purchase something for 100 and we did the return of capital, you're selling at 150 and the return of capital came down to 50, you'll be taxed on the 150 minus 50. So there's no other return on exit taxation that would be triggered.
Correct.
Targeted year of exit varies. Like I mentioned, it could be between 4 to 7 years to ensure we get the maximal exit price.
Right. So, question from uh, Rajesh Kadam. Will be restructuring store commercial property in prime location or in metro cities? I guess it's the question Sarthak is all about. Where all are we looking at REITs, maybe?
Yeah, so a good question. So right now, of course, in the past we've done acquisitions in Mumbai, Pune, and Bangalore. That being said, now we are also looking at Hyderabad, NCR, Chennai, and these are from an office market perspective, right? These are the cities that we talked about that are outperforming from a year-on-year perspective. That being said, for other assets such as warehouses, hospitals, and other such infrastructure, schools, we're open to a much larger pan-India presence. That being said, the biggest volume of assets that get traded tend to be under the office spectrum. So you're more likely to see something like that come up first in some of the key metros. But we'll definitely be looking at bringing opportunities on a pan-India basis that are beyond metros, but possibly more towards other infrastructures related assets.
Sure. So there's a question. There are no available schemes listed on your website. Is there any opportunity available currently? Well, no, at this moment, no. But we should be signing a particular scheme very soon. And as I mentioned, our IPO of the particular scheme should be there Jan end. That's what we're looking at this moment. Please be in touch with your investment manager at HBITS. Follow us on LinkedIn and, of course, be a part of our WhatsApp channel. There's regular updates coming over there. That's our community, which is actually, asking several questions over there. A question from Bhairav Iyer, sorry for that. So could you please tell me what are all the documents needed to prove ourselves as property owner? Uh, Question for you, Sarthak.
Yeah, sure. So in the SM REIT concept, we as an investor will be buying units of the SM REIT scheme. Now the SM REIT scheme will have an SPV under it, right? That SPV is going to purchase the property, and that the it will have an ownership document saying that this is a so it could be a sale deed, it could be a share purchase agreement, could be whatever that transfers the ownership of that property to the SPV. So the SM REIT holds the SPV, and as an investor, you hold units in the SM REIT. So that's the trail of ownership, and that's how multiple people can get fractional ownership in that. That is how the concept emerged. But in this case, now it is units basically of an SM REIT, and ultimately the SPV will have all the title documents, the sale deed, etc. That a registered sale deed, in fact, that ensures ownership is in the name of the SPV.
Well, particularly as well, just to mention, the units will be showing in your demat account, right? So all the units, give an example, you purchased, parked in, let's say, crore rupees, you purchased 10 units. You'll be seeing 10 units in your demat account, which will be the biggest, ownership document attached to it. And you'll see that name going back to that particular scheme where you have invested. And that scheme is going to be a part of that particular trust, the holding company, where the asset is registered. Question from there here. Which are the best cities in India to invest in real estate currently, and which gives a very good return in the future, sir?
Yeah, so right now it depends on the asset class you're looking at, but from an office perspective, um, Mumbai, Bangalore, Pune, Hyderabad, Chennai, all are extremely good. Now it's not just about the city though. The micro market becomes important, right? So Pune, for example, has a lot more supply coming in the next 2 to 5 years. So that whether so when that supply comes in, you want to be more careful about which micro market has very low vacancy and low projected sort of upcoming supply also. that will keep your return high. So, for example, in Pune, right now, Baner is a very good micro market to continue to look at because vacancy is low over there and supply will take a little bit of time. So, it's not just the city as such. You have to look at city plus the micro market of that city to make sure you have a good return.
Question from Mr. Rajiv Chawla. Is exiting as easy as selling shares? Who will purchase the unit? Yes, it is as easy as selling the shares. Not to worry on that front, sir. Anonymous Delhi, who is our independent registered valuer? Saket.
So at the moment we were in the past we've always worked with JLL and we did not have to have another IBBI certified valuer in the fraction space, but now we are looking to work with all of them. We've already interacted with most of the IPCs who also have a affiliated independent valuer. So who we ultimately go with may change based on the asset. I think there's no one specifically fixed, but it will be one of the leading IPCs and one of the leading IBBI valuers. And there are only a handful that do all the listed REITs. So it will be one of those four or five that are there.
Next question is from Mr. Hardik Dixit. When is HBits coming with next opportunity? Yes, Jan, and we're looking forward to surely get an opportunity for you. Part of the question is, of course, second Dash recently got the SEBI registration cancelled, which is, of course, one of our peer company's name. The one of the people who are doing into fractionalship. And how do you ensure builders? So I understand you're talking about one of our competition, or actually another company who deals into fractionalship. They are not yet SEBI regulated. So if you say that, how do you ensure builder is abiding by terms and conditions? Uh, Now we are SEBI regulated. Any opportunity which will come under this particular scenario will be as per SEBI compliance. And as Sarthak has already mentioned, our legal partners are Shardul Merchant Mangaldas, Cyril Merchant, and of course Trilegal. These are among the top five law firms we are actually dealing with. Agreements will be watertight. One major reason why that thing happened with that particular organization was I could feel is that it was a build to suit warehouse where we are not dealing in a build to suit kind of a scenario. We are looking at a pre-leased, ready commercial outfit. So there is no requirement of any builder coming into picture and talking about his terms and conditions. So that would mitigate your thought, and the risk is already mitigated over there. Rajesh Kadam, can capital gain amount can be invested in REITs? I guess no, to some extent, because if you're looking at residential to residential, that's the one which the question is which you have. In this particular, you're dealing with shares. REITs is now considered as equity. So you can as well check as per your book how you want to book your profit and losses over there with your chartered accountant. Uh, Mr. Rajiv Chavla, can you share a calculation sheet for 5 years investment for say rupees 50 lakh investment? Well, I'll say to Sarthak, please sign the term sheet first. We need to give the Excel sheet to
Yeah,
Mr. Chavla
no,
very
of course.
soon.
Yeah, absolutely. When we launch the scheme, which will be soon, we will have a calculator over there, so you'd be able to enter your amount and be able to see what your yield will be as well as what your ultimate return will be.
Right. Thank you, Sarthak. Uh, Question is, would REIT be classified as a mutual fund or stock? Primarily, want to know from US taxing point of view. Well, right now, with the new thing coming to picture, REITs is now considered as equity. So you need to look at equity taxation in India. And of course, when we talk about the DTAA, that's double taxation avoidance agreement, you need to check as per the equity schemes between the US and the India agreement in terms to what is the kind of scenario. But yes, you have to invest from your demat account. Mr. Jay Prakash R, can a person hold the property beyond 5 years, say 15 years or instance? Question for you, Sarthak.
Yeah, I think it depends, right? If the SM REIT decides that this is the right time to exit, and of course we will have to take investor consent at that point to exit. If the majority votes in favor, then everyone that holds a unit would get their share of the capital appreciation and final value, right? So, but should the SM REIT not have sold, right? And you can continue to hold your units indefinitely. There is no limit to how long you can hold your units.
Right. How a question from KK Mukesh Pandya. How our investment is safeguarded and any guarantees available to protect our capital? Well, just to let you know, first of all, we are very particular. There is no word such as guarantee, first of all, right? Just to let you know, because there could be, but at HBITS, if I've already shown the performance track record in terms to the two exits, that clearly showcases that we look at the property very minutely for the entry price point. Let's look at a further example or statement. We are talking about 3 to 5 years rental income locked in, a rental agreement done in place in advance. So even if it is like a 8%, 8 into 5, 40, you're already getting a 40%. So I don't think so there's anyways there is going to be ever a problem in terms to the capital. It's going to be intact. uh, Anonymous attendee, what should be HBIT's fees on our investment amounts? Will it be calculated as per decreased capital amount or fixed at initial investment during the tenure? It will be as per the fixed initial investment done throughout the tenure. And we are not going to be, so if the property values goes up, it cannot just increase over there. So it's going to be fixed. Let's say if it's like investment in 1 crore, and let's say our management fees is 1%, we'll charge you a lakh rupees. So that's how the scenario is going to be all. But you're already adding something,
Yeah, it'll be very publicly mentioned fees at the start and exit in the scheme documents.
of course. So while you invest with us, the prospectus which will be given to you, each and every details with the cash flows clearly mentioned will be available for you to your viewing before you even invest a single rupee with us. Question. mm, Monthly payout will also be directed by SEBI. Is that they have directed or a quarterly payout as of today? As of now, it is going to be quarterly payout. Since you mentioned that after 15 months, it might be a month. So see, please understand, okay, name is not there. Please understand when we talk about quarterly payouts, this is the mechanism which is just starting. Okay, we are getting the compliance. This is the first IPO. It's not for us. It's basically the industry just made. They would need always as a comfort, and for the tenant, we need to as well have a comfort of how the monthly payments coming. And as of now, if you look at fraction ownership, we were doing monthly payments any which ways. But this, of course, I guess 15 months could be the longest time which we are talking about, where the monthly payments will start. Vishwanathan L, what are different charges from your end? As of now, only one I could say is basically the management fees, but of course, will be listed on the prospectus, which will be showing before you invest, and you can look at the cash flows. There's a question from anonymous attendee. In real estate, if we reinvest the amount received from a sale of property into another property, the LCD is exempting does such. So again, as I mentioned, uh, you're talking about residential to residential, the capital gain tax, which is a problem. That's how why the residential people want to buy residential only. But if you look at the effect, and there was one of my client who did a classic example and an analysis where in the rentals of residential, they were getting around 2% rental income. But if I'm talking about, and that is 2% taxable. And in SM REITs, if you're talking about like a 8% tax free paid out quarterly, if you put a classic example, you get your money break even in 2 years, and still you're making a very good plus money. Even after capital gain tax, you will see your IRS easily touching 10%, even after you pay the capital gain tax. Question from Jay Prakash are, how do you differentiate yourself from your competitors? Well, there are many. Sarthak, if you want to start off something to say.
Yeah, so see, I think broadly you would have seen in the fractional space there were initially six, seven players, and that ultimately came down to two or three players, right? And so in the SM REIT space right now there are only two, but what that are active. What I will say is that you know we maintain an extremely thorough diligence process, right? So as an acquisitions person, I can say while say a deal may seem attractive, until every dot is teed, the investment won't happen from our side, or even an offer doesn't go out from our side until we tick off everything that's possible. So I can't speak for everyone else, right? Every competitor may handle things differently, but we're in it for the long haul, right? We're all experts that have actually built our careers in this business, and we want to see this business continue to grow. We believe in the market. We've got a high conviction for commercial real estate in India. We want to democratize retail participation. So for all of those things, we will be doing everything with the highest level of diligence, ethics, and with the goal to safeguard your investment, right? And so while there are no guarantees, there is a lot of certainty that this is a safe investment if we put it forward to you.
Nicely said, and which is what I was looking forward to say as well. And as well, just to mention, there is no competition as of now. The penetration of market is just started, sir. So if you look at an industry, the commercial market is looking at a trail boom now, uh, and we see that trend happening. People will be unlocking their money because this is going to be new IPOs coming with just a 10 lakh rupee investment in the properties per se. So it's going to be a great time in the coming years. Well, uh, I'll have a question again from same. Can you also put some light how the SEBI gardening the investor from an unfortunate event, example, the competition? Well, you can, if you want to answer, Sarthak.
Yeah, so in this case, right, so the DRHP process is a very thorough process, right? So the event that we're referring to is in the fraction space, also for a pre-leased property under construction. That can be done under an AIF where you are permitted to have those kind of risks. In the case of SM REIT, we are going to be putting forward a DRHP that gets approved by SEBI. It has to be a pre-leased product. And SEBI also is going to review that DRSP and then approve whether or not that can get listed. So the fact that it gets listed is SEBI's guardrail to begin with from any potential unfortunate events. Now, in real estate, there is always a potential risk that the tenant may vacate, and in that case, the cure is you will fill that space, and it can take about 3 to 9 months. But that being said, that when we sort of covered the presentation, we were stressing on how our acquisition criteria process is looking at the long-term tenants, micro markets that have high demand, and then also trying to get the lock-ins in place or term sheets in place for extensions, so that the main event of a turnover of a tenant is protected, right? So and then of course in terms of the building quality and things like that, there's a public technical due diligence report that's put as part of the DRHP. So uh, barring any force majeure event, there isn't anything that could risk the investor from that perspective. Uh, Maybe I think you're on mute. Yeah.
Yep, sorry for that. Thank you. Well, I could see one last question over here, which is particularly just to mention, would the new purchase automatically be done via Demat account going forward? Yes. It's going to be SEBI compliant, going to be only bought through Demat and will purchase from NSE BSE, how the IPO process happened for a particular company. Now it's a particular scheme. That's what the entire process will be. Well, I don't see any more questions, so I'd like to thank you all, attendees. Thank you very much for taking out this time and be a part of this presentation. I see a great number of people being there steady, listening to us. Thank you very much. Thank you, Sarthak, for giving us such insights about different locations, the rental trends, about the exit, and how you're looking forward to acquire the further properties. So for everyone over here, look forward to all of you to, if you would follow at LinkedIn, we'll give you, send across the recording links for this particular webinar, and as well as the WhatsApp channel, which we regularly engage and pass on the information. Thank you very much. It was great having you all. Thank you very much.
Thank
Thank you,
you.
Sarthak.
Yeah.